An Iran conflict just locked in permanent inflation. Not a spike, a regime change. We're at stage 4 of a 7-stage cycle that took 9 years to break last time, using tools we can't use now. Tehran, October 1973. OPEC ministers signed the embargo document. Oil quadruples from $3 to $12 per barrel. President Nixon authorizes emergency monetary expansion to prevent economic collapse. Inflation embeds for a decade, requiring 20% interest rates and double-digit unemployment to finally break. Washington, February 2025. Different crisis, identical mechanism. The Strait of Hormuz is threatened, 20% of global oil supply at risk. Treasury bond yields are spiking as inflation expectations unanchor. The Federal Reserve will restart bond purchases within weeks, printing $95 billion per month to prevent auction failures. The Strategic Petroleum Reserve buys 90 days of buffer time. After that, the real choice begins. Deep recession or permanent inflation. Debt to GDP at 123% means recession is political suicide. The 1973 playbook required Paul Volcker raising rates to 20% and accepting 10.8% unemployment to break the inflationary cycle. That solution doesn't exist anymore. The question isn't whether energy shocks cause inflation. It's whether anyone understands the covenant buried in the term sheet. This time, the inflation doesn't end. This is stage 1, the abundance illusion. Here's why this matters to you. Gasoline at $3.50 per gallon and heating bills under $150 per month feel normal, manageable even. But that pricing assumes a supply cushion that no longer exists. The boardroom reality looks like this. Global oil markets are priced for 95 million barrels per day of supply, with 4 to 5 million barrels per day of spare production capacity sitting idle. That spare capacity is the margin separating normal from crisis. It's the difference between stable prices and price shocks that cascade through the entire economy. Picture the energy market as a corporate credit line with a $5 million limit. For the past 3 years, you've only drawn 2 to 3 million, so the limit feels infinite. You finance a lifestyle, make investments, build dependencies, all assuming that access will never tighten. The cushion creates complacency. That was the global energy market from 2020 through 2023. The shale boom created a massive supply glut. OPEC lost pricing discipline during the COVID demand collapse. Oil inventories hit 15-year highs. Politicians and analysts talked confidently about the energy transition. Here's the deal structure that created the abundance illusion. 3 components working together. Component 1, North American shale production hit 13 million barrels per day, adding 8 million barrels per day of new supply since 2010. This broke OPEC's pricing monopoly temporarily, flooding markets and driving prices down to $50 to $60 per barrel at various points. Component 2, COVID-19 demand destruction. Global oil consumption fell by 20 million barrels per day in April 2020. Markets interpreted this as evidence that peak oil demand had arrived, that electric vehicles and work from home would permanently reduce consumption. Supply suddenly seemed infinite relative to this new, lower demand baseline. Component 3, the Strategic Petroleum Reserve stood at 650 million barrels before 2022. That's a 180-day emergency supply stockpile for the United States. The existence of this massive buffer calmed any supply anxiety. If something went wrong, the government had reserves. The safety net was there. Here's what this abundance meant for you personally. The average U.S. household spent just 3.2% of income on energy costs during 2020 through 2022. That's historically low, around $2,400 annually for a median income household earning $75,000. Cheap gasoline enabled exurban housing developments 30 to 40 miles from job centers. Long commutes became affordable. SUVs and trucks captured 78% of new vehicle sales by 2023. The abundance illusion created structural dependencies across the economy. Businesses invested heavily in energy-intensive supply chains. Long-haul trucking networks, air freight logistics, just-in-time inventory systems that assumed cheap fuel forever. Housing developers built massive suburban subdivisions 40-plus miles from employment centers, assuming gasoline would stay affordable. Automakers tooled entire factories for pickup trucks and SUVs, betting consumer preference would continue because fuel costs were negligible. Every major economic decision from 2015 through 2023 embedded the assumption that $70 to $80 oil was the permanent ceiling. that supply disruptions were a thing of the past, that OPEC had lost its pricing power forever. But here's the problem with that assumption. The abundance was real but temporary. OPEC regained production discipline in late 2022 and 2023. Saudi Arabia, Russia, and the UAE coordinated production cuts totaling 2 million barrels per day, deliberately removing supply to stabilize prices in the $80 to $90 range. Shale production growth is slowing dramatically. Drilling costs are up 60% since 2020 due to labor shortages, equipment costs, and reduced access to capital as investors demand profitability over growth. The easy shale plays are tapped. What remains requires higher prices to justify drilling. And our global spare production capacity has collapsed from 5 million barrels per day in 2020 to just 2 million barrels per day by late 2024. That's the entire margin for error. Any supply disruption above 2 million barrels per day cannot be absorbed by simply turning up production. There's no slack left in the system. You might be thinking, we have renewable energy now. Solar and wind are growing exponentially. Electric vehicles are coming. We're transitioning away from oil dependence. The internal combustion engine is dying. This whole analysis is backward-looking. Here's the problem. Oil demand is still running at 100 million barrels per day globally. Renewable energy provides roughly 6% of total primary energy consumption worldwide. Electric vehicles represent 9% of new car sales in the US, but only 3% of the total vehicle fleet on the road. The energy transition requires 30 to 40 years minimum under optimistic scenarios. Battery production capacity, charging infrastructure, grid upgrades, all of this takes decades to build out at the scale required. Meanwhile, global spare oil production capacity dropped from 5 million barrels per day to 2 million barrels per day. Let me be completely clear. The abundance was real. Prices were low, supply was plentiful, the strategic petroleum reserve was full. But every component that created that abundance has reversed. OPEC has discipline again. Shale growth is plateauing. Inventories have normalized. The reserve has been drawn down to 350 million barrels, 46% below the 2019 peak. And that's just stage one. Stage two is where the supply cushion disappears entirely, and markets begin pricing in geopolitical risk that hasn't mattered for years. Britain in 1945 thought it was wealthy. £3.5 billion in sterling balances, frozen reserves held across the empire. Then the 1949 devaluation hit. Those reserves lost 30% of their value in a single weekend. The wealth was an illusion built on unsustainable currency arrangements. The same pattern is playing out now, except the reserve asset is cheap energy instead of sterling balances. This is stage three, the geopolitical catalyst that triggers the margin call. Here's why this matters to you. The Strait of Hormuz moves 20 million barrels per day of crude oil, on roughly 20% of total global supply. A disruption there isn't a supply concern you monitor on the news. It's an immediate 15 to 20% supply loss with zero alternative routes ready to compensate. The boardroom mechanism. Iran conflict escalates from containment to kinetic enforcement operations. The oil market immediately prices in supply access restriction, either an actual closure of the shipping lane or a credible enough threat that insurance costs make tanker transit economically impossible. Picture a corporate credit line again. You're borrowing $4.5 million against your $5 million limit, leaving just $500,000 in available headroom. Suddenly, the bank issues a margin call. Reduce your outstanding draw to $3 million immediately, or face technical default and credit line termination. That's the global energy market when geopolitical risk activates. Total consumption runs at 100 million barrels per day. Available spare capacity sits at just 2 million barrels per day. Any disruption exceeding 2 million barrels cannot be offset by increasing production elsewhere. The system has no shock absorber left. The Strait of Hormuz closure mechanism operates through three distinct vectors. Vector 1 is direct physical supply loss. 20 million barrels per day flow through this narrow shipping lane between Iran and Oman. Iran can credibly threaten closure via naval mine deployment, anti-ship cruise missiles positioned along the coast, or proxy militia attacks on commercial tankers. There is no alternative pipeline infrastructure to reroute Persian Gulf oil exports from Saudi Arabia, the UAE, Kuwait, and Iraq around this choke point. Vector 2, insurance premium explosion. Even if the strait remains technically open, war risk insurance for tanker voyages spikes from $50,000 per trip to $500,000 or higher when conflict escalates. Shipping companies avoid the route entirely to protect their assets and crews. This creates a de facto supply reduction without Iran firing a single shot. Vector 3. Futures market amplification. The paper oil market trades roughly 15 times the volume of the physical market. Hedge funds, pension funds, commodity trading desks, all bidding up futures contracts based on supply fear and geopolitical headlines. Prices spike before actual barrels are lost. The financial market moves faster than the physical market, and those paper prices determine what you pay at the pump. Here's the concrete impact on your household budget. Oil futures jump from $75 per barrel to $110 to $120 within 2 weeks of serious conflict escalation. That price shock translates directly to gasoline at the pump. Prices rise from $3.50 per gallon to $5.50 or $6.50 per gallon within 30 days. Not gradually, overnight in some markets. The median U.S. household operates 2 vehicles, driving roughly 12,000 miles per year, each at an average fuel economy of 25 miles per gallon. At $3.50 per gallon, monthly fuel costs run about $200. At $6 per gallon, that jumps to $400 per month. That's an additional $2,400 per year just for transportation fuel. Heating oil and electricity costs pass through similar increases because natural gas and diesel prices track crude oil movements. So you add another $1,500 to $2,000 annually for home energy. The price shock forces immediate government intervention. The president authorizes strategic petroleum reserve releases, 1 million barrels per day for 90 consecutive days. That's 90 million barrels total, roughly 26% of the remaining 350 million barrel stockpile. This emergency drawdown temporarily caps gasoline prices by adding supply to the market, preventing prices from spiking even higher. But here's where the math becomes catastrophic. The reserve release buys 90 days of price relief. After that 90-day window closes, if the conflict continues and the strait remains disrupted or threatened, there is no emergency stockpile remaining. The buffer is gone. Prices spike again, on top potentially even higher than the initial shock because markets know the government has no remaining ammunition. The second-order effects cascade rapidly. Airlines immediately cancel marginal routes and add fuel surcharges to remaining flights. Trucking companies impose fuel pass-through fees on shipping contracts. Businesses operating on thin margins, restaurants, retail stores, small logistics firms, face potential insolvency if energy costs remain elevated for more than 2 quarters. Consumer spending contracts as households redirect income from discretionary purchases to transportation and heating. October 1973 provides the historical precedent. Arab oil-producing states embargoed shipments to the United States and allied nations in response to the Yom Kippur War. The embargo removed 4.4 million barrels per day from global markets, roughly 7% of total supply at the time. Crude oil prices quadrupled within 5 months, from $3 to $12 per barrel. Gas lines formed across America within weeks. President Nixon implemented rationing by odd and even license plate numbers. You might be thinking, the United States is a net energy exporter now. We produce 13 million barrels per day of crude oil. We export liquefied natural gas to Europe and Asia. We achieved energy independence under the shale boom. Global supply shocks don't affect us the same way they did in the 1970s. Here's the problem with that assumption. Oil is a globally traded commodity with a single global price benchmark. U.S. refineries are configured to process specific crude grades, light sweet versus heavy sour. We export much of our light tight oil from shale basins and import heavier crude grades that our refineries were designed to process. The U.S. still imports 6 to 7 million barrels per day despite being a net exporter on paper. When the global benchmark price spikes, domestic gasoline prices spike within days, regardless of U.S. production levels. Refineries pay global market prices for crude inputs, and energy independence means nothing if refineries cannot source the specific crude grades they need to operate efficiently. The supply chain is globally integrated. No major economy is actually insulated from global oil price shocks. Bottom line, the Strategic Petroleum Reserve buys 90 days of breathing room. After that window closes, the real choice begins for policymakers. about accept a deep recession as energy costs crush consumer spending and corporate profits, or restart monetary expansion to prevent economic collapse, knowing that inflation will accelerate. And that's just the margin call. Stage 4 is where the Federal Reserve makes its decision: defend the economy or defend the currency. History shows they always choose the economy, which means they always choose inflation. The mechanism is about to lock into place. This is Stage 4, forced monetary expansion. We are at this stage right now. Here's why this matters to you. When crude oil prices spike from supply shocks, Treasury bond yields spike simultaneously because investors demand higher returns to compensate for expected inflation. If the Federal Reserve allows those yields to rise freely, mortgage rates hit 8 to 9%. Onto credit card rates jump to 25% and higher. Corporate borrowing costs surge and the economy tips into immediate recession. So the Fed will restart quantitative easing, printing money to buy Treasury bonds and cap those yields. That's the mechanism that locks in permanent inflation. The boardroom covenant looks like this. The Federal Reserve announces temporary Treasury bond purchases, $95 billion per month, framed as emergency support for financial stability. The official narrative is preventing disorderly markets and maintaining liquidity. The reality is forced lending to prevent the federal government from facing failed bond auctions and spiking interest costs. Picture a corporation facing an acute cash crunch. Revenue is declining because economic activity is slowing. Debt servicing costs are rising because interest rates are climbing. The CFO faces two options. Option 1, cut spending drastically, lay off 30% of the workforce, slash capital expenditures, and stabilize the balance sheet through brutal austerity. Option 2, convince the company's largest lender to extend the credit line at below-market interest rates, providing breathing room to avoid immediate collapse. That's the dynamic between the U.S. Treasury and the Federal Reserve. The Treasury must refinance $7.6 trillion in maturing debt over 2025 and 2026. These are bonds issued during the ultra-low interest rate period from 2008 through 2021 that are now coming due. If bond market yields spike from the current 4.2% to 6%, the annual interest expense increases by $137 billion. That's the entire NASA budget plus the entire EPA budget combined, just to service the higher interest costs. Politically, that's unacceptable. Congress will not authorize massive spending cuts or tax increases to cover ballooning interest expenses. So the Federal Reserve becomes the backstop buyer, the lender of last resort, ensuring that Treasury auctions clear at manageable yields. The rescue mechanism operates through three covenant structures embedded in monetary policy. Covenant 1 is the auction backstop. The Treasury holds weekly bond auctions requiring approximately $95 billion in demand to absorb new issuance and refinance maturing debt. Foreign central banks have been net sellers for 18 consecutive months, reducing their Treasury holdings by $180 billion. Primary dealers, the major banks required to bid at auctions, cannot absorb the full issuance load without Federal Reserve support. The Fed announces $95 billion per month in bond purchases to stabilize auction demand. Covenant 2, the yield cap mechanism. The Federal Reserve claims it's targeting financial stability, not monetizing government debt. But the functional effect is identical. By purchasing long-dated Treasury bonds, the Fed artificially suppresses yields below where inflation expectations would naturally push them. The 10-year Treasury yield stays anchored near 4.5% instead of rising to 6% or higher. This keeps mortgage rates, corporate borrowing costs, and government interest expenses lower than free market conditions would allow. Covenant 3, the political override that prevents exit. Once bond buying restarts, any attempt to stop triggers immediate market panic. Long-term yields spike, stock markets fall, credit spreads widen. Politicians demand the Fed support the economy. The Fed chair testifies before Congress that the employment mandate requires accommodative monetary policy to prevent job losses. The covenant becomes clear. Money printing can start, but it cannot stop without triggering the very crisis it was meant to prevent. Here's the household impact translated into concrete numbers. Every $1 trillion in new Federal Reserve bond purchases historically accelerates consumer price inflation by approximately 1.8% over the following 12 to 18 months. The Fed will print $1.14 trillion over 12 months at a $95 billion per month pace. That pushes inflation from the current 3.8% baseline to 6 to 7% by late 2026. Your savings account currently pays 4.5% annual interest. Inflation running at 6.5% means you're losing 2% per year in real purchasing power. $100,000 in savings loses $2,000 in real value annually. Compounded over 5 years, that's a cumulative purchasing power loss exceeding $10,000. The money is still there nominally, but it buys significantly less. Now we have to address the elephant in the room. The monetary expansion triggers defensive corporate pricing behavior. Large corporations with pricing power, firms controlling 75% of industries, according to recent market concentration studies, begin raising prices preemptively before cost increases actually hit their operations. Why? Because executives know inflation is coming. They know competitors will raise prices too. And first mover advantage in price increases protects profit margins. This becomes self-fulfilling. Businesses raise prices in anticipation of inflation. Workers demand wage increases to compensate for higher living costs. Businesses raise prices again to cover higher labor expenses. The wage price spiral activates even before the energy cost shock fully passes through the economy. The 1974 through 1975 precedent is instructive here. President Nixon and his successor Gerald Ford both pressured Federal Reserve Chair Arthur Burns to maintain accommodative monetary policy despite inflation running at 11%. Burns complied, printing money to backstop Treasury auctions and prevent recession before the 1974 midterm elections. That decision embedded inflation expectations for an entire decade. Now, it took Paul Volcker raising interest rates to 20% in 1981 to finally break the cycle. You might be thinking, the Federal Reserve learned its lesson from 2021 and 2022. They called inflation transitory and were proven completely wrong. Powell and the FOMC won't repeat that mistake. They'll keep interest rates high this time, even if it causes short-term pain, to prevent inflation from becoming entrenched. Here's the problem. Federal debt to GDP currently sits at 123% compared to 106% in 2019 and just 31% in 1980 when Volcker began his inflation fight. Every 1% increase in the average interest rate on government debt adds $350 billion to annual debt service costs. The federal government literally cannot afford to let interest rates rise to the 8 to 10% level required to crush inflation expectations without triggering a sovereign debt crisis. And unemployment above 6% historically triggers electoral wipeout for the party in power. The recession required to break inflation would push unemployment to 9 to 11% based on historical patterns. No politician survives that. The pressure on the Federal Reserve to prioritize employment over price stability becomes overwhelming. They will choose inflation over recession because voters punish job losses far more severely than they punish rising prices in the short term. If you understand nothing else, understand this. The rescue is the trap. Once the Federal Reserve restarts quantitative easing to prevent Treasury auction failures, inflation expectations unanchor permanently. Markets begin pricing 5 to 6% inflation as the new baseline rather than a temporary spike. Long-term bond yields reflect that expectation. Wage negotiations embed cost of living adjustment clauses. Rent contracts include automatic inflation escalators. And that's how Stage 4 bleeds directly into Stage 5, the wage price spiral that transforms temporary inflation into a permanent regime. The mechanism is already locking into place. This is Stage 5, the wage price spiral activation and permanent wealth transfer. Here's why this matters to you. Once inflation runs consistently above 5% for 12 consecutive months or longer, it embeds itself into economic contracts and expectations. Workers demand cost of living adjustment clauses in employment agreements. Businesses raise prices preemptively. Landlords index annual rent increases to the consumer price index. Social Security benefits get automatic inflation adjusters. Every contractual decision locks in the assumption that high inflation is permanent, which makes it permanent. The wealth transfer mechanism. Inflation expectations shift from the historical 2 to 3% norm to a new 5 to 6% baseline, and that elevated expectation becomes self-reinforcing through contract indexation, pricing behavior, and monetary policy constraints. Picture a corporate restructuring where the company survives as a going concern, but the original shareholders lose 60% of their equity value through dilution. New investors inject capital, receive majority ownership, and the old shareholders see their stake reduced to minority positions. Now, the firm continues operating, revenue keeps flowing, but ownership has been transferred at the original investor's expense. That's inflation as wealth redistribution. The federal government holds $34.8 trillion in debt, all denominated in nominal dollar terms. If inflation runs at 6% annually instead of 2%, the real inflation-adjusted value of that debt falls by 4% per year. The government's liability shrinks in real terms. Who pays for that liability reduction? Anyone holding dollar-denominated assets, savings accounts, treasury bonds, fixed-rate mortgages as lenders, defined benefit pension promises. The wealth stripping operates through three primary channels. Channel 1 is negative real yields on fixed income investments. The 10-year Treasury bond currently yields approximately 4.5%. If inflation runs at 6.5%, investors earn a negative 2% real return annually. Every year you hold that bond, you lose 2% of purchasing power. $500,000 invested in Treasury bonds loses $10,000 per year in real terms at negative 2% real yields. Compounded over a decade, that's more than $100,000 in purchasing power destroyed. The nominal balance stays at $500,000, but what that money can actually purchase in goods and services has declined by more than 20%. Channel 2, Cost of Living Adjustment Indexation Lag. Social Security benefits adjust annually based on the prior year's Consumer Price Index readings. If inflation spikes from 3% to 7% over 6 months, retirees experience the full 7% price increase immediately. Their benefit adjustment arrives 12 to 18 months later, based on the previous year's lower inflation reading. They never fully catch up to where they would have been under stable 2% inflation. 67 million Americans receive Social Security benefits. The average monthly benefit is approximately $1,900. A 4% real purchasing power loss over 2 years due to indexation lag costs the average retiree $1,800 annually in lost real income. Multiply that across 67 million beneficiaries. Channel 3, the housing equity illusion. Home prices rise with inflation. The median home price increases from $420,000 to $520,000 over 4 years in a high inflation environment. Homeowners feel wealthier on paper. Their net worth statements show significant gains. But the mortgage payment remains fixed at the original amount. Meanwhile, grocery costs increase 30%, gasoline costs rise 60%, property tax assessments jump 25%, tracking home values and homeowners' insurance premiums spike 40%. The nominal wealth gained from home appreciation is phantom. You cannot eat home equity. The house is worth more, but everything else you need to buy costs dramatically more as well. Here's the concrete impact on different household profiles. A retiree with $500,000 in savings, earning 4.5% interest annually, loses $10,000 per year in real purchasing power at 6.5% inflation. Over a 10-year retirement period, their savings buys what $350,000 would have purchased under 2% inflation. That's a $150,000 wealth haircut. And now not from a stock market crash or bad investment, but from monetary policy choices made to avoid recession. For wage earners under age 50, the math is slightly different, but similarly destructive. You might negotiate a 6% annual raise to match inflation, but that raise is taxed at your marginal income tax rate, 22 to 32% for middle-class households. So a 6% nominal raise becomes a 4 to 4.5% after-tax raise. You're still losing ground against 6.5% inflation, just more slowly than retirees on fixed incomes. The second-order wealth transfer accelerates capital flight into inflation-hedging assets. Wealthy households, the top 10% by net worth, shift portfolios aggressively toward real assets, income-producing real estate, commodity futures, foreign currency positions, gold and precious metals, equity stakes in businesses with pricing power. These assets tend to appreciate with or faster than inflation. The top 10% of households own 70% of stocks and 50% of real estate by value. These holdings protect and even enhance real wealth during inflationary periods. The bottom 50% of households hold the majority of their wealth in cash savings and fixed income bonds, assets that depreciate in real terms during inflation. Wealth inequality widens not through policy design, but through the mathematical mechanics of how inflation affects different asset classes. The 1975 through 1980 period demonstrates this pattern clearly. Inflation averaged 9.2% annually, while savings accounts paid 5 to 6% interest, creating guaranteed real losses for savers. Retirees on fixed pensions watched their purchasing power collapse by 40% over 5 years. Meanwhile, homeowners with fixed-rate mortgages and investors in stocks and real estate saw their real wealth protected or enhanced. You might be thinking, wages will rise to keep pace with inflation. Unemployment is historically low, labor markets are tight, workers have significant bargaining power. This inflation might actually be fine for workers who can negotiate higher wages, unlike retirees on fixed incomes. Here's the vulnerability nobody wants to discuss. Wage growth lags price growth by 12 to 18 months on average. Corporations can raise prices for goods and services immediately in response to cost pressures or inflation expectations. Workers negotiate wage increases on annual cycles, often facing resistance from employers trying to protect profit margins. During that 12 to 18-month lag period, real wages adjusted for inflation fall. And when wage increases do materialize, businesses immediately pass those labor costs through to consumers via another round of price increases. Real wages, the purchasing power of worker earnings after adjusting for inflation, have been flat or negative for approximately 70% of workers since 2021, despite historically tight labor markets and record job openings. This is the part that should concern you. The asset stripping phase transfers wealth silently, without market crashes or dramatic headlines. It's slow-motion erosion of purchasing power. No single month feels catastrophic. But compound that 2% annual real loss over a decade. Not in half your savings purchasing power has vanished. And that's stage 5. Stage 6 is where central banks attempt to regain control by raising interest rates, only to discover they no longer have the political or economic capacity to follow through. The inflation becomes permanently embedded. This is stage 6, policy impotence, leading directly into stage 7, the regime reset. Here's why this matters to you. The Federal Reserve will eventually attempt to fight inflation by raising interest rates, just like Paul Volcker did in the early 1980s. But federal debt levels are 4 times higher now than they were then. Any interest rate above 5.5 to 6% triggers cascading corporate defaults, regional bank failures, and pension fund insolvency. Financial markets will force the Fed to reverse course within weeks or months. When that reversal happens, when markets understand the central bank cannot sustain high rates, inflation expectations reset permanently higher. The endgame, 4 to 6% inflation, becomes the new accepted baseline. Your lifetime savings lose half their purchasing power in 12 to 15 years instead of 35 years under the old 2% regime. Picture a corporate CEO attempting to implement a 50% workforce reduction to cut costs and restore profitability. But the board of directors vetoes the decision because mass layoffs would trigger customer exodus, supplier panic, and potential bankruptcy. The CEO is trapped, cannot cut costs deeply enough to survive long-term, cannot generate enough revenue to cover current expense levels. That's the Federal Reserve's position. Now, the textbook response to entrenched inflation requires interest rates of 8 to 10%, following the Volcker playbook from 1980 through 1982. But the debt and financial system cannot withstand rates at that level without triggering systemic collapse. The policy impotence operates through 3 binding constraints. Constraint 1, debt service explosion. The federal government currently pays approximately $1.1 trillion per year in interest expense at an average 4% effective rate across all outstanding debt. If the Fed raises rates to 6% and Treasury yields follow, annual interest costs jump to $2.1 trillion. At 8% rates, interest expense hits $2.8 trillion annually. That exceeds the entire combined budget for national defense plus Medicare. There is no political path to cutting $1.7 trillion from other spending categories to accommodate that interest cost increase. Congress will not authorize it. Voters will not accept it. The constraint is absolute. Constraint 2, financial system fragility. Regional and community banks hold approximately $620 billion in treasury bonds and mortgage-backed securities purchased during the 2020 through 2021 ultra-low rate period. Those bonds were bought when 10-year yields were 1 to 2%. If yields spiked to 6%, those bond portfolios lose 20 to 30% of their market value. Banks must mark those losses, depleting capital reserves and triggering regulatory violations. Silicon Valley Bank's failure in March 2023 demonstrated this dynamic. A $1.8 billion loss on bond holdings forced by depositor withdrawals caused immediate insolvency. Now imagine that scenario playing out across hundreds of regional banks simultaneously if the Fed pushes rates too high too fast. Constraint 3. The political mandate override. The Federal Reserve's dual mandate requires maximum employment alongside price stability. Any unemployment rate above 7% triggers electoral crises for the party in power. The recession required to break 6% inflation would push unemployment to 9 to 11%, based on historical correlations. No elected official survives that level of job destruction. Politicians will pressure the Fed relentlessly. Congressional hearings demanding rate cuts. Media campaigns blaming the central bank for unnecessary economic pain. Executive branch officials publicly criticizing Fed policy. The political system cannot tolerate the recession necessary to break inflation expectations. Here's what this means for your financial future. Baseline inflation expectations reset from 2% to 4 to 6% indefinitely. Your retirement savings of $500,000 loses half its purchasing power in 12 to 15 years at 5% inflation versus 35 years at 2% inflation. Monthly household expenses currently running $4,000 will cost $7,200 in 10 years at 5% inflation, compared to $4,880 at the old 2% baseline. Social Security cost of living adjustments will not keep pace because they use trailing 12-month CPI data with methodological quirks that systematically understate real inflation. Housing costs, medical expenses, food, and energy will rise faster than official CPI measures. Retirees will experience persistent erosion of living standards even with automatic benefit adjusters. Let me be completely clear about what happens next. The pattern is mechanically complete at this point. 7 stages from abundance illusion through policy impotence to regime reset. The 1973 energy shock cycle took 9 years to resolve, requiring Paul Volcker raising the federal funds rate to 20% and accepting 10.8% unemployment to finally break inflation expectations and restore 2 to 3% price stability. That solution does not exist today. Debt to GDP was 31% in 1980. It's 123% now. Volcker could raise rates without triggering sovereign debt crisis. The current Fed cannot. The political system could accept 10.8% unemployment for 2 years in 1982. It cannot now. The safety nets are larger, the political coalitions more fragile, the tolerance for economic pain dramatically lower. The regime reset creates a permanent 2-tier economy. The top 20% of households by net worth hold diversified portfolios. Stocks and companies with pricing power, income-producing real estate, alternative assets that appreciate with inflation. They maintain or improve their standard of living even as the currency depreciates. The bottom 50% hold the majority of wealth in cash savings, checking accounts, and fixed income bonds. These assets depreciate in real terms at 4 to 6% annually. Wages lag inflation by 12 to 18 months. Real purchasing power declines structurally, not due to lack of work ethic or education, but due to asset allocation and the mathematical mechanics of inflation. Here's where it gets worse. Once inflation expectations anchor at 5 to 6%, they become self-sustaining. Workers demand wage increases to match. Businesses raise prices preemptively. Landlords index rent escalators to CPI. Municipal governments adjust tax rates and fees to maintain real revenue. Every economic actor builds 5 to 6% inflation into their planning. The central bank cannot break this without inducing depression-level unemployment. And depression-level unemployment is politically impossible in a democracy with universal suffrage and established social safety nets. The inflation becomes embedded in the system's architecture. The timeline is faster than anyone wants to admit. We are at stage 4 right now, forced monetary expansion. Stages 5 and 6 follow mechanically over the next 12 to 24 months. The wage price spiral activates, policy tightening attempts fail, and stage 7, regime reset, becomes the accepted reality within 2 to 3 years. This isn't speculation, it's pattern recognition based on historical precedent and current constraints. The math doesn't lie. The debt levels, the political incentives, the institutional fragility all point toward the same outcome. Permanent inflation regime replacing the 2% stability that defined the past 3 decades. 7 stages. We've completed 3. We're at stage 4, the point where monetary expansion becomes irreversible. Same room, same treasury auction screen, different numbers. And the 1973 precedent required Paul Volcker raising rates to 20% and accepting 10.8% unemployment over multiple years to break the inflationary cycle. That solution is impossible now. Debt to GDP at 123% versus 31% then. Political tolerance for unemployment has collapsed. The covenant was always clear to those who read the term sheet. This wasn't about whether energy shocks cause inflation. That's established. The question was whether the debt trap had closed to the point where the inflation couldn't be stopped. It has, and it can't. The Iran conflict was just the catalyst. The mechanism was already locked and loaded, waiting for the trigger. This isn't a crisis, it's a liquidation. The wealth transfer has already begun.